It sure seems like this was a very V-shaped bottom, should we believe the bounce that we saw for the major markets yesterday.
Well, I think it is a continuation of the trend. You know, little jitters like we had last week and sharp downturns, mini corrections are normal in bull markets. The problem is people still remembering the ghosts of 2008, and they think, is this it? Is this the big one? But all they need to do is continue to look at the earnings reports. And we saw a lot of earnings reports yesterday that were terrific, and those aren't going to stop. So I think the bull market is continuing. Sure, it's a little long in the tooth, and that does cause some concern, but the underpinning for the sound economy and strong earnings are here, and we don't see that changing.
So Mark, as we talk about these strong earnings, we are expecting 20% plus earnings growth again, maybe around that 7 and 9% sales growth. Is that enough in a market that sits close to record highs to continue this bull run that we've seen all the way back to 2009?
Well, it's an expectations game, and you make a good point. A lot of the good news is behind it, and how do we have that continued earnings growth rate next year? We may need another catalyst, but we may get one. We don't know if we're going to have an end to this tariff talk, or if we may even get an infrastructure spending bill. But if we get another catalyst for next year, we could see a move like this. Otherwise, moves up in single digits, low double digits, that's nothing to sneeze at for the investor.
Mark, is the economy strong enough for this overall? We've mentioned earnings. The backdrop for corporate earnings is good. We're at multi-decade low unemployment. Everybody seems to be working. We know that that's not truly the case, but you get the idea. The macroeconomic picture is solid, but not gangbusters. So can that be enough from a bigger picture standpoint to keep this environment going as well?
I think it's enough to keep a slow, steady upward trend with interim volatility like we saw earlier this week. You mentioned the underpinnings. The consumer is strong. Debt levels are down relative to 2008. Earnings growth is approaching 3% year over year, and the job market is tight. Ask any employer looking to hire people what they're having to pay relative to previous years, and they're going to tell you it's a tight job market. None of that are underpinnings for an economic recession, and recessions and the Fed are the two reasons to worry about stocks. Right now, the Fed is talking tough, but it's measured hikes, and the recessions are not in the cards. So we think this could continue into 2019.
All right, so it's fair to say that you're bullish. We did see a lot of bullish price action yesterday in certain sectors, in particular in certain industry groups. I think mainly large cap technology, certainly semiconductor stocks, and social media stocks that have been beaten up as well. Are there opportunities that are more attractive to you given the recent pullback that we've seen?
Well, the market's rewarding top-line revenue growth, and they're punishing slow growers. Look at the disparity between Netflix and IBM yesterday. That's all you need to see between new tech and old tech. The market wants to see revenue growth. Where the money is also going, though, are value stocks. I think you're going to see a slight rotation into some of the underloved financials. If we have a strong economy like I think we do, there's no reasons for financials to be wallowing at these levels, and we think their earnings reports justify a little more attention to them.